Now friends, we are moving on to the next concept, that is types of GST. So this types of GST gives us, as to what are all the various types of GSTs that we have, and that depends upon what is the nature of supply. So first we need to know the nature of supply, then only we will be able to know as to what are the various types of GSTs that we have. So totally the supplies are divided into intrastate supply and interstate supply. What is supply? Supply is the taxable event under GST. So that is, whenever manufacture takes place, there used to be excise duty, and whenever there used to be sales, there will be sales tax, and whenever there is import or export, there will be customs duty. Likewise, what is the taxable event in case of GST? The taxable event is supply of goods or services or both. So this supply meaning we are going to learn in the next segment as to in detail what is the meaning of supply, what are included in the meaning of supply, what are excluded from the meaning of supply, because supply forms the basis of levy or the taxable event for the purpose of levy of GST. So that part we are going to see later, but now what we are trying to understand is that this supply is divided into two. So that is intrastate supply and interstate supply. Okay. What is intrastate supply? If the location of supplier and the place of supply. So you can check this in page number 4. So intrastate supply versus interstate supply. Intrastate supply means if the location of supplier and the place of supply. There are two factors that we need to keep in mind. So the first factor is the location of supplier and the place of supply. If location of supplier and place of supply is in the same state or same union territory, then it will be known as intrastate supply. Likewise, if the location of supplier and the place of supply is in two different states or two different union territories or a state and a union territory, then it will be known as interstate supply. Okay. So again I am repeating, if the location of supplier and the place of supply is in the same state or same union territory, it is intrastate supply. If the location of supplier and the place of supply is in two different states, two different union territories or a state and a union territory, then it will be known as interstate supply. If it is intrastate supply, so within the state, intrastate supply within the state, then there will be CGST plus SGST. That will be the combo, because already we know that India follows dual GST model. So CGST plus SGST. Suppose if it is intrastate supply and within the union territory, then it will be CGST plus UTGST. Whereas in case of interstate supply, it will be only one tax, that is IGST. So what are the combinations of GSTs that we have? Intrastate, CGST plus SGST, or CGST plus UTGST, whereas interstate it will be IGST. What is the full form of CGST? Central Goods and Services Tax. SGST, State Goods and Services Tax. UTGST, Union Territory Goods and Services Tax. And IGST refers to Integrated Goods and Services Tax. So IGST will come into picture only in case of interstate supply, whereas the other four, CGST, SGST, UTGST, other three, so will be coming into picture in case of intrastate supply. Now, the two factors that decides whether a transaction is intrastate supply or interstate supply is the location of supplier and the place of supply. So, what is this location of supplier and place of supply? We need to have a little clarity here. Location of supplier, if you see, so it depends upon whether the person is registered or not. Even if they are registered, so whether they are rendering services from the registered place or any other place. So now, location of supplier is divided into three. Number one, they are supplying from the place where they have obtained registration. They are supplying services from the place where they have obtained registration. Then that registered place will be taken as the location of supplier. Suppose if they are supplying services from a fixed establishment elsewhere, then that fixed establishment will be taken as the location of supplier. Suppose if they are not supplying services from the place where they have obtained registration or the fixed establishment, then in the absence of these places, it will be usual place of residence. So in other cases, it will be usual place of residence. This is what typically the location of supplier. For example, if there is a restaurant and that restaurant will be definitely supplying services from the place where they have obtained registration. So then what will be taken as the location of supplier? The place for which they have obtained registration will be taken as the location of supplier. Whereas if you take, a person who is having a chartered accountant or a cost accountant, so who is having an office and he is also taking classes. So he is having office, but he will not take classes from his office. He will be taking classes in a coaching center or in some other establishment. So that establishment where he is taking classes will be taken as the location of supplier. Suppose if there are some services which are provided online. So now say for example a dietitian, so or a trainer, so who is giving online classes with respect to the diet to be followed or the type of exercises to be done, etc. So then in that case, so there is neither the place from where they have registered they are providing and nor it is from a fixed establishment. So that particular dietitian or that fitness trainer, so whatever is the usual place of residence, that will be taken as the location of supplier. So this is what about location of supplier. Then place of supply. Place of supply, yes, it is something which is very difficult to determine because we have a big chapter called as place of supply, big segment called as place of supply. There we are going to discuss for different situations what is the place of supply, because the place of supply is not static or cannot be defined like this location of supplier. The place of supply depends. Sometimes it is the location of supplier. Sometimes it is a location of recipient. Sometimes it is a location where services are actually performed. Sometimes it is a location of immovable property. So we have multiple provisions when it comes to place of supply. So that place of supply, case to case basis, transaction to transaction basis, let it be goods or services. So we need to determine that separately. So once we determine this location of supplier and place of supply, we will know whether it is intrastate supply or interstate supply. So now, what are the various GSTs that we have? CGST, SGST, UTGST, IGST. These are the 4 GSTs. And who are levying these GSTs? CGST is levied by central government. And on what? Intrastate supply. SGST levied by state government on intrastate supply. UTGST is levied by union territory. So, but union territories are under whose control? Or under the control of central government. So, can we say that UTGST is levied by central government? Yes. Anyhow, CGST is levied by central government, UTGST is also levied by central government. Then why we need to have 2 separate GSTs? Because central government wanted to know how much the union territories are contributing in the form of GST for that reason. Because CGST means it is not only the union territory but every state, everything will come into the common pool called as CGST. But central government wanted to know, so how much is the union territory's contribution? Due to that reason, we have a separate entry or accounting head called as UTGST. And the next thing, IGST. Who levies IGST? Central government only. And it is levied on what? Interstate supply. Now, IGST is opposite of dual GST model. So what is it we have seen in dual GST model? In dual GST model, both central government and state government commonly levy, but in IGST only central government is levying. So then that deviates from the principle of dual GST model? No, not at all. So let's try to understand how this IGST works. Let's take a seller who is located in Tamil Nadu and a buyer who is located in Karnataka. So the seller who is located in Tamil Nadu, when he is making supply to a buyer who is located in Karnataka, so then it is an interstate supply, assuming that the place of supply is Karnataka. Location of supplier Tamil Nadu, location of recipient Karnataka, and the place of supply Karnataka. Therefore, it will be interstate supply. And in case of this interstate supply, so IGST is applicable. So now this seller who is in Tamil Nadu will pay IGST to the government. Now that government, which government? Central government. Central government. Central government will retain 50% of this GST what is paid by the seller. Say for example, the seller who is located in Tamil Nadu has paid say 8,000 rupees as IGST to whom? To the central government. Now in that 4,000 rupees will be retained by the central government and remaining 4,000, because India follows dual GST model And what is the share of CGST? 50-50. So then, which means that 4,000 rupees is retained by central government, then what happens to the remaining 50%? Remaining 50% will be given to the state government. Which state government? Is it the Tamil Nadu or is it the Karnataka? To which state government it will be given? So it will be given to the consuming state. So what is the consuming state here? Karnataka, because the recipient is in Karnataka and the place of supply is Karnataka, consuming state is Karnataka. So the central government is going to give 4,000 rupees to state government of Karnataka. So GST follows a destination based tax concept. So what is destination based tax? So wherever the goods or services is getting consumed, so to that state the revenue should go. So that is the logic here. So IGST collected by central government, 50% is shared with the consuming state based on place of supply. Got it? So this is about IGST. So we have seen what are the various types of GSTs. Now, in this IGST, there is one problem. What is that? Before 1/7/2017, before 1/7/2017, on this interstate sale means just now we have seen one example, Tamil Nadu to Karnataka, that's an interstate sale. So before 1/7/2017, on interstate sale, the seller's state was getting CST revenue. So CST, even though levied by central government, but it is collected and retained by the state government. So before 1/7/2017, on interstate sale, so there was CST revenue which was going to seller state, in our example Tamil Nadu. Whereas with effect from 1/7/2017, what has happened? On the same interstate supply, now it is interstate supply, IGST, 50% goes to central government and 50% goes to Karnataka. Then whatever revenue that was getting or that was earned by the Tamil Nadu government, now in GST regime that is lost. So why? Because in GST it became a destination based tax, but CST, central sales tax, earlier was a origination based tax, means the seller's state is going to get the money. So what is the date of implementation of GST? Already we have seen that the date of implementation of GST is 1/7/2017. From 1/7/2017 plus 5 years is the initial time frame for levy of compensation cess. And the time frame has got completed by 2022, 5 years. So there was a provision which says that it can be extended for a further period as decided by the GST Council. So this 1/7/2022 got further extended till 31st March 2026. Now the compensation cess got extended till 31st March 2026. This is an amendment. White Finance Act 2022, applicable for May 23 and November 23 exams. So therefore, till 31st March 2026, they extended the levy of compensation cess. So now, what are the various GSTs, types of GSTs that we have? Total 5. CGST, SGST, UTGST, IGST, and the 5th one, compensation cess. So these are the 5 GSTs, types of GSTs that we have at present. Okay, let's move on to the next concept, that is input tax credit in GST, which you can see in page number 4. What is input tax credit? Input tax credit means the tax paid on inward supplies can be availed as ITC and adjusted against the tax payable on outward supply. For example, there is a trader. This trader is having some inward supplies. On that inward supplies, the trader has made a payment. So the price paid by the trader is, say, 10,000 rupees plus 12%, that is 1,200 rupees. 11,200 is paid by the trader. This 1,200 can be taken as credit. And the trader is having some outward supplies. On the outward supplies of the trader, so there will be receiving some price plus GST, say 15,000 rupees plus GST 1800 rupees is received. So 16,800 is received. So this 1800 is the liability of the trader, and this 1200 which is paid on inward supply is the input tax credit. Now what a trader can do? This trader can take this 1200 as credit and adjust against his liability 1800. So the net amount that he pays to the government is only 600. The logic is simple. 1800 what the trader gets from the customer. So 1200 already he paid at the time of purchase is recovered. So the balance 600 rupees is given to the government. So in other words, net liability equals to gross liability, that is 1800 minus input tax credit. So this is the equation. So net GST payable equals to gross GST payable minus input tax credit is the formula that you need to remember. A person who is making zero rated supplies will have two options. Option number one, first, say there is a person who is making zero rated supply. Say exporter who is making zero rated supply. Now this person will have some inward supplies also. Okay. Now option number one, that is pay IGST upon export. That is, so this person is making sale na. When this person is making sale, on that whatever is the value on that IGST is payable. By whom? By this exporter. Pay IGST on export. How he will pay IGST? Already he made some inward supply na. In that inward supply some ITC will be there. Using that ITC he will pay GST on export, and balance he will pay out of cash. Now get refund of the entire GST to him as a refund, gross GST. Say for example, on inward supply the ITC is 14,000 rupees. On outward supply the liability is 20,000 rupees. So using 14,000 he will pay 20 plus 6,000 rupees he will pay out of cash. Now he will get refund how much? How much he paid? 6,000. That plus already he paid 14,000 at the time of purchase. That. So both together 20,000 he will get as a refund. That is option number one. Pay IGST and use the ITC, avail ITC. Yes, we studied just now. What is that? If my outward supply is zero rated, I can take ITC on my inward supply. Correct? So take the ITC, adjust with the liability and get the refund of gross amount. What is that gross amount? 20,000. How 20,000? So 14,000 paid on inward supply, which availed as ITC. That 14,000 he will get as a refund. Plus 6,000 what he is paying out of his pocket at the time of export also he will get as a refund. So what is the tax burden to him? Zero. That's why it is called a zero rated supply. Next. Option number two is there. That option two is he will export without payment of GST. So this person will make export without payment of GST. There is no GST. However, whatever GST paid at the time of purchase will be availed as ITC, and he will get the refund of ITC. In our example, he paid 14,000 rupees on purchase. That 14,000 he will get as a refund. So then also the tax incidence is going to be zero. So that's why zero rated supplies. So export of goods or services, supply of goods or services to SEZ, these are zero rated supplies. There will be some GST payable and we'll get a refund of that. That's why it is called a zero rated supply. So zero rated supplies does not mean nil rated supplies. So whenever my outward supply is zero rated, I can take ITC on my inward supply. There is no issue. Now one more point is that if I am making exempted supplies, I cannot take ITC on inward supply, correct? But if that exempted product, if I am exporting, so I have a product, say this pen is an exempted product. If this pen I am selling, in India, it is exempted. No need to pay GST. So on purchase of this pen, I cannot take ITC. Got it? Whereas the same pen, when I am exporting, will become zero rated, and on purchase of this pen, whatever GST paid, I can take ITC. Means on purchase of this pen, in the sense on purchase of raw material related to this pen. So I can take ITC. And when I am exporting it, but when I am selling this in domestic market, it is exempted. On purchase of the raw material used for this, I cannot take ITC. So that is the simple logic which we need to remember. Situation number 1, my purchases is interstate. My purchases, inward supplies is interstate. Then what is the GST paid, IGST paid? Say the IGST paid is 20,000 rupees. Okay. Then my outward supply is intrastate. Then what is the GST payable? CGST, SGST payable. Let that CGST, SGST payable be 12,000, 12,000. CGST 12,000 payable to central government, SGST so payable to state government 12,000. Now we have here IGST paid on purchase. So to central government how much? 20,000. Now in the 20,000 I am using 10,000 for payment of CGST and 10,000 for payment of SGST. 10,000 for payment of CGST, 10,000 for payment of SGST. Done. So now still I have to pay 2,000, 2,000 that I will pay, but IGST how much I have used? 10,000 and 10,000. Now as IGST is with central government, IGST credit is with central government and CGST also payable to central government, there is no settlement. When you adjust 10,000, there is no settlement. But IGST is with central government and SGST is payable to state government. When you set off this IGST with IGST credit with SGST liability, then the central government has to pay the 10,000 rupees to the state government under IGST settlement. Why? Because IGST credit is with whom? Central government. SGST payable to whom? State government. So the 10,000 when you set off, so central government has to pay the 10,000 rupees to state government under IGST settlement. Now you may get a doubt. Same situation arises when CGST credit is adjusted with SGST liability in sir. It is impossible because CGST credit cannot be set off with SGST liability. SGST credit cannot be set off with CGST liability. There is no cross utilization of credits adjusted with the liabilities between CGST and SGST. Not possible. So therefore, IGST credit can be set off with SGST liability, yes. Then central government has to pay the 10,000 rupees to state government. Now second situation. What is that second situation? My inward supply is intrastate. So CGST paid, SGST paid. CGST paid to central government, SGST paid to state government. Okay. How much? CGST paid say 10,000, SGST paid 10,000 rupees. Now my outward supply is interstate. So IGST liability, say that IGST liability is 25,000. Now I can use this 10,000 CGST and 10,000 SGST for IGST, correct? 10,000 CGST, 10,000 SGST for payment of IGST. Now, when CGST, which is with central government, used for payment of IGST, that is to central government, there is no settlement when you do that 10,000 set off. But when SGST of 10,000, when that SGST of 10,000, you are using for payment of IGST, so the 10,000 SGST is with state government. When you are using it for payment of IGST to central government, then the state government has to pay 10,000 rupees to central government. In the previous case, central government paid to state government. Here, state government will be paying 10,000 rupees to central government under IGST settlement. So, this IGST settlement will not be done by the taxpayer. So, taxpayer just do the adjustment, but on the back end, GST network will do this settlement between the central government and state government. So, when IGST settlement will arise, two situations. When IGST credit is set off with SGST liability, central government has to pay that money to the state government. When SGST credit is set off with IGST liability, then the state government has to pay that amount to the central government. And this IGST settlement is done by the GST network.